Testing, testing. So, just working on this live stream, see what happens. We'll update on the markets. Testing. Is anyone here? All right. So let's look at some market stuff while we're here. So, interesting day in the markets. We had several days where it went down 5, 6%, and today's up a couple of percent. Some interesting things to look at. So, oil was up 2.5%. And if we look at Oxy was up 3.5%. So Oxy tends to move in line with oil. And I know people jumped into this trade when they saw Warren Buffett buying it. And he was buying it as high as like $62, I think. So when you see $37, it looks like a screaming bargain. But there's a lot of uncertainty in the markets with the Trump tariffs, and if Trump succeeds in destroying the economy, things are produced with energy, and oil is energy, so that bodes poorly for oil prices, and it bodes poorly for Occidental because Occidental is tied to the price of oil. So even though oil went up a couple of points today, 61 is still very cheap for oil. 70 or 80 is great. 100, this company would be making money hands over fist, but at $37, it's kind of fairly priced because oil is so cheap. And the reason this moves such in line with oil, because obviously oil companies move up with the price of oil, but some move more than others. And why is that? Because it depends whether they're hedged or not. So when you hedge something, you lock in the future price. So when you sign a 1-year lease on your house, you've locked in the price for 1 year, you've hedged that, right? So you're not exposed to rising rent prices, at least for the next year. And a company like Oxy doesn't like to hedge their exposure. So they benefit more when the prices go up, and they sort of suffer more when the prices go down. But they hedge very little of their exposure, I think like 25% of their exposure. Whereas if you look at another company like Vermilion, Vermilion hedges about half of its exposure, and Vermilion does mostly natural gas, not oil, but about half of their forward production is hedged and half is exposed to the spot market. So a company like this, even though we're talking about natural gas instead of oil, will suffer less when when the price of their commodity goes down, and subsequently will not go up as much when the commodity that they're tied to goes up, because as I said, half of their production is locked in at prices that are predictable. And a company like Oxy, they've only hedged about 25% of their price to oil. So when you look at the price of crude oil, and it's gone down from 100 to 70 or 80, where it vacillated for most of last year, and now it's down to $61. 75% of their production is not hedged. So this is going to be very volatile when the price goes down or up. And that's why, even though Warren Buffett was buying this at 62, and people were saying what an incredible bargain it is at 50, what an incredible bargain it is at 45, what an incredible bargain it is at 40, at 37, you're sort of making a bet on the price of oil, not specifically the company. And that's one thing to think about. There are some things that look really cheap, and it's going to depend on what's going on in the world and what's going on in the markets. So Tesla's hot garbage. We're not going to touch that. But Crocs, So I wear Crocs. I have 2 pair, and then when they wear out, I buy 2 more pair, and so it's sort of almost like a subscription model for this. And right now you're getting it at incredibly cheap, which is a PE of 5.8. So at 6 times earnings, you're getting a company that is growing double digits in Europe. They made a terrible acquisition of a fashion brand called Hey Dude, but their core Crocs brand is still growing double digits in Europe. It's still steady in the US. And even if you do nothing with Hey Dude, you're getting the whole company at less than 6 times earnings, which is, incredibly cheap for a company like this, which has very little debt. It has a very recognizable brand that I think is durable, especially in a downturn. So a couple of problems with it. One, people say, well, what about knockoffs? If you go to Amazon and you search for Crocs and then you sort by price, high to low, and sort by price, low to high, you'll see they go anywhere from the cheapest ones are literally $20 and the most expensive ones are $200. So if you're going to make something that's better than Crocs or cheaper than Crocs, you don't have much room to go either way. And, it's if you're going to make something less than $20 to try to knock this off, wouldn't you just buy this? So why is it trading so cheap? It was as high as 165 this year. Why is it 92? Well, one, Trump is destroying the economy, and two, they import a lot of stuff. And if you're importing these from abroad, from China, and there's 100% tariff, that's obviously going to hurt it. And if you think that that is temporary and that will go away, then this is a great company. If you think that that's going to not go away, then it is kind of fairly priced. So it's very easy to make this. It's called injection molding. And if you look at a pair of Crocs, there's 2 pieces. There's the foot thing and then a little strap. So you just need 2 molds to make this and some injection molding. And you can make a mold for this for about 150,000. So if you wanted to knock off a specific kind of Croc, each one you need 2 molds, 150,000 each, and one for size 10, one for size 9.5, one for size 8. But if you're going to make a premium one, as I said, this is a name brand that people recognize, and they go up to $200. How are you going to advertise and try to displace that in people's mind? Two, if you're going to go cheaper, this goes down to $20 if you search for them on Amazon. So it's kind of hard to knock this off because they're knocking themselves off. So that's my thought on that. Here's some other stuff in my portfolio. This is Ammo Inc. Preferred. And if you look at this, it's got 10.5% dividend. So why is this company trading so cheap? So these are the preferred shares for a company called Ammo Inc. And Ammo Inc. is a terrible company to own. I don't trust management, but that's just my opinion. And this company owns 2 things. They own the gun broker website, which is very highly trusted for people who buy guns. If you look at on Trustpilot, it's got an A. And gun broker is very profitable, but they also have a company that makes ammunition, and they are terrible at making ammunition. They lose money on it. They open up a new headquarters to make ammunition, and are losing money every quarter with it, because if you're an ammunition company and you can't make ammunition, you should not be in the ammunition business. And they finally figured that out, and they sold the ammo business to Olin. Olin is a company that makes chemicals, and they also own, I believe it's the Winchester brand of ammo, and they also own a ammunition plant in Arkansas that makes a ammunition for the U.S. Army, and the Army owns the equipment. Olin makes it for them, and whenever there's excess capacity, Olin can make their own ammo and sell it. And so they're buying the ammo business from Ammo Inc. And Ammo Inc. makes kind of specialty ammo, so they have tracers that are not flammable. So tracers, the Army uses them to shoot at night, so you'll see where you're shooting. The problem with tracers is that they're flammable. So if you're practicing with it, you could burn down the forest. But the University of Louisiana, I believe, came up with this process where you can make tracers which are not flammable, and Ammo Inc. licensed it. So they make this specialty ammo. However, they don't do it well because they lose money. And in my opinion, management is pretty incompetent. But the one competent thing they did is they're selling off the business. So they're selling off the business to Olin, and they paid about I want to say 200 million for Gunbroker. So you're getting the company for less than they paid for Gunbroker, and they're getting rid of the ammo business. So if you look at the statistics, it's worth 152 million. And then if you take out the debt, sorry, they have no debt, but they have cash, right? So if you deduct the cash, you're getting the whole company for 150 million because they have 50 million in cash and only 14 million in debt. So you got 35 million in cash. So you're paying 152. Think if you bought a hot dog stand and there's you paid $2,000 for it and there's $500 in the register. Well, you didn't pay 2,000 bucks for it then. You paid 1,500, right? So it's 152 million. If you deduct out the cash, you're really buying the whole company for 115 million. Okay. So 115 million, they're selling the ammo business. They got 75 million coming in. So now you're getting Gunbroker. If you deduct 75 million from that 15 million, you're going to get 40 million, right? And they paid 200 million for Gunbroker, and you're getting the whole company for like 40 or 50 million after they sell off the animal business and have this cash coming in, right? So this company had accounting problems, and they're actually in danger of being delisted from the exchange, and that's why it's so cheap now. But even though they're trying to work through this, and they hired a law firm and outside accountants and whatever to try to bring them current, that shouldn't affect the preferred share. So what the preferreds are sort of like debt. You don't make as much money when it goes up. You don't lose as much when it goes down. You got a 10% dividend here, and they're callable next year at par. So par is $25. So if you held this for a year, you're getting 10.5%, and then they call it next year at 25. You're going to get this 10.5% dividend plus another 20% when it's called next year, if it's called. So what does callable mean? It means they can say, we're going to give you $25, and then you give us the shares back. And why would they do that? Well, they're paying a lot of money for this, right? So if this wasn't at $21, if this was at $25, they were paying about 8% interest on this, right? But now the price is so low that you're getting 10.5. And if they have no debt, they had 35 million in cash, they got another 75 million in, and they're paying 8% interest. That doesn't make a lot of sense. So they can buy these back next year when they become callable at par, which is $25, getting the 10.5% plus 20%. And in a year, that would be a 30% return. And it would be kind of locked in, but there's no guarantees in life. But why do I feel comfortable owning this? Because what are they going to do with all that cash besides buy this? So if they're paying 8% and they can call these shares and they have 75 million laying around, they don't have the ammo factory anymore. They just have this very profitable website, Gunbroker, which doesn't require a lot of maintenance. What are you going to do with all that cash? You're going to pay a huge dividend. You're going to buy back shares, or you can call these. Because if they have 75 million, they can stick it in the bank. Well, 75 plus the 35, they're going to have $100 million. And if they stick it in the bank and they get 1 or 2% interest, or they can buy these back and get 8% interest. And, in the meantime, you're collecting 10% on the dividend, and you're getting, if they call this at par, which is $25 in a year, I think that's a nice return and a pretty safe risk reward thing. So that's my thinking on it. Anyway, some other things. Enovix, this is a really interesting company, and it sort of got beat up when Trump got elected and people started hating on green energy because the person who is involved with this company, TJ Rogers, was involved with a company called Enphase, which makes solar panels, but this has nothing to do with solar panels. These guys make really innovative batteries. which use silicon in the anode instead of regular lithium. And why is that important? Because you can make 30% stronger um, in the same size container. And also, they don't catch fire. There's a really interesting video where you can Google Enovix, and you'll see him drilling into a battery with traditional lithium and drilling into this one. The traditional one, like the one in the Tesla cars, when you drill into it, the whole thing catches on fire. But this one, when you drill into it, it doesn't catch fire because the way you normally make batteries is, you have these layers with gooey stuff in the anodes and cathodes, and then you roll it up like this, like a battery that you would stick in your iPod, right? Double A, and they call that the jelly roll method. But this has a different method, and if you picture it, it's like lining up spaghetti in a box, and so when you poke a hole in it, it doesn't puncture much, and it also has room to expand. So normally, if you put silicon in an anode and it gets charged, it expands, which is why you can't put it in a car, because if you had the jelly roll method like a Tesla and you overcharged it, then boom, it would blow up. But with this, the flat method, it can expand. It's got room to expand. It's got 30% more, and it doesn't catch fire, unlike the Tesla when you puncture it. Now, why is that important? Because they have military contracts. So military uses this, when they're carrying their equipment with the radio and everything, and this has a 30% longer life in the same size battery, and it doesn't catch fire when you puncture it. And that's important because if you're in the military and somebody shoots you and you're wearing something that'll catch fire if it's punctured, after you've been shot, the last thing you need is to be set on fire. So military contracts for this, and also very good application to cell phones and headsets. So VR, virtual reality is becoming big, and they have samples out for VR makers. I think this is pricey because they're not making any money yet, but it's one to watch if you're into that speculative things. For less risky things, I do own POOW for Ammo Inc. And I think I talked about it in a previous video. And there's a couple of others that I own. I'm buying now, Enterprise Products and Energy Transfer. So this came down, I think it was as high as what, 34? And so now you're getting it at 29. It dropped to 27 this week and was a screaming bargain. So 7%, and it's a pretty safe dividend because this company has pipelines where they have natural gas and stuff like that. And so it's sort of like operating a toll bridge. And I mentioned before about the price of crude and the price of gas going up and down, and some companies are exposed to it and some companies are not. You know who's not? A pipeline operator, because whether the price of crude is $60 or 160, they're still charging you to move it through their pipes. Same thing with natural gas. So you're getting a nice dividend on this, 7%. And what's good about this is their income, their debt. Most of it is locked in for a really long time. So I think some of their debt, like 50 or 80%, is locked in for 30 years, which is incredible. So it's a really good asset play that way. And another interesting one is Energy Transfer. And I think they have better assets, but the financing isn't as good as 30 years locked in forever. But this one pays 8%. And my thinking on this is sort of like, if you have these risky things in your portfolio that blow up when tariffs and other things start lobbing hand grenades at your portfolio, it might be good to have a basket of stuff like this, which pays you a nice fixed income. And therefore, even if the market's down, you still have some money coming in that you can redeploy to other things. So that's my thought on this. Hold on a second. Let me see. I got some messages here. Are you worried at all about the Permian Basin and Oxy? There's also going to be a lot of carbon capture in the Permian. I guess they'll make money off of carbon credits. That's a good question. And that's a really great question. There's a company that I used to own called the Tess. And I did a video on that. I think I made like 50% in 1 year on that, and plus a dividend. And they own oil plays, like little pieces of other oil fields all over the place. And it's pretty cheap now, and it has a 10% dividend. But these guys aren't in the Permian. They're in the Eagle Ford. And what's interesting about Oxy is that most of their assets are in the Permian. And the reason that's interesting is if you look at the different oil fields, the Permian, the Eagle Ford, and the Appalachian, I can't remember all the names, but most of them are in decline. So, you produce more and more and more every year, and then at a certain point, it starts to decline. And all of those are in decline. I don't have a chart of it, but you can pull up a chart. The only one that is still going up, not down, is the Permian. And I think that's what Warren Buffett was interested in. And people speculate like, oh, this is a bet on inflation that he's making, or this is to hedge his other positions. I don't think so. I think it's much simpler than that. I think if you look at all the other fracking plays in the US, there was a time when they were all going up at the same time, but now most of them are in decline. And the only one that's still going up is Permian. So once the excess gets wrung out of the oil market, I think the one that'll be left standing, the last man standing, is Permian. And I think the people that are there are going to do really well. Carbon capture is really interesting, but I think it's new, so it's very speculative. And under the Biden administration, there was incentives to engage in these carbon neutral or carbon reducing um, renewable plays like carbon capture. There's something called the Inflation Reduction Act, and you would get in your first year a 30% tax credit for these things. So not a tax deduction, actual tax credit. So if you owed $100 million, you invested $100 million in a project like this, like Occidental would, you get a $30 million tax credit, 30 million off your taxes on that. So I think that's part of what makes the carbon capture thing interesting. And I think part of the reason that the Oxy is so cheap now is with Trump doing away with everything that happened under the Biden administration, even things that help him, there's a chance that he could do away with the carbon credits as well. So I think that's what they're seeing there. Hold on, my phone is going off. I'll be right back. But if you have any other questions or comments, put them in the chat. If anyone disagrees with me, go right ahead. I can take it. So that was that. What are some other interesting ones? DEA. I did a video on this, and I mentioned so DEA property. DEA rents property to the federal government, and that's why it's getting the shit beat out of it right now. So it was a nice dividend, and normally a nice long-term tenant. The only thing that is similar to this, there's one that's a REIT, a real estate investment trust, that does the stuff for the post office. But this is a lot better play, DEA, and with the government shutting down whole agencies and trying to cancel contracts willy-nilly, this has become a lot more risky. They did make a good step towards financial viability by cutting their dividend in half a day or two ago, and that was a source of the decline in price. But it's probably a smart move. In these crazy times, you want to preserve your cash. So that's DEA. And one thing to think about also is the VIX. So when the VIX is above 30, that's usually a sign of panic. And the VIX is a measure of volatility. And now is in the marketing, and the tariffs like 8. And I did a video on this, and I said, this isn't maximum panic yet. When it goes above 30, that's panic. And I think the second day of the tariffs, it went to like 45 or 50. That was panic. So 37, it's still panic territory, and doesn't mean that you shouldn't buy, but you should be aware that people are panicking. So you don't want to panic when everyone else is panicking. But if there are things that you had on your watch list, which were always too expensive, and now they're cheap, it's, might be a good time to consider it. So one of the things like Mercado Libre, that's always expensive. If everyone is panicking now and that sells off, maybe you add that. Companies that always look too expensive, like Amazon or Facebook or Google, are now trading at pretty cheap earnings ratios. So if you look at the VIX, which is a measure of the panic in the market, And again, above 30 is normally a sign of panic. The first day of the tariffs, it was 28. Second day of the tariffs is like 50. So now it's 37. It's still panic territory. And what you want to do is not panic. What you want to do is look at companies that you really liked, but always look too expensive, like Amazon or Meta, or there's one that I like called MSCI. It always looks expensive. I own some of it. There's a company called FICO, which is always ridiculously expensive. And that if that comes down because people are panicking and dumping everything, that might be one to look at. But put your suggestions here. Is there anyone that you're interested in that you've been looking at but always looks too expensive and now suddenly seems reasonable? Just put it in the comments and we'll take a look. And let's see, I mentioned, so Meta, if we look at it, Meta is the best advertising company in the world. And if you look at it now, it is trading at 544, and it was as high as 740 this year. So it looks expensive compared to some other companies, 22 times earnings, but 22 times earnings for the greatest advertising company on the planet is incredible. So if you advertise on Meta or you advertise on Google, there's a huge disparity in prices. So if you want to advertise, for instance, for solar batteries on your roof, like Tesla does, right? Or like Enphase does, you will pay about 30 cents per click on Google. You pay about $3 on Meta. And why is that? Because the clicks on Meta are much more valuable because they know more about you. So they know exactly who to show those ads to, and they can charge a lot more money with them. So every click that you click, every like on every post, they know about it. They know your age, where you live. So if you want to pay for an ad and only target women with a college degree in Manhattan who like the band, whatever, Meta will do that for you. Google can't do that for you. And that's why they can charge so much money per click on Meta, Facebook, because they have so much information on you. So Google gets 30 cents per click. Meta will get $2 a click. The only company that will charge even more per click is LinkedIn, amazingly. So on LinkedIn, the same click that will cost 30 cents on Google or $3 on LinkedIn, you might pay up to $20 on LinkedIn. And why is that? Because on LinkedIn, you can say, only show this to people with the title CEO in their bio, or only show this to people working at Microsoft. You can really dial it down. Whereas on Facebook, they might not be able to slice and dice like that because you might not put who you work for on Facebook because you don't want people finding you there. But on LinkedIn, you want people to find you professionally. So that's the only company that can charge more than Facebook. But Facebook, billions of users, literally 3 billion on Facebook, and they also own WhatsApp and Instagram. There's no company that's even close. And I know some of you are going to say, what about TikTok? The problem with TikTok is TikTok can hurt Facebook, but they're not very profitable. And why is that? Because TikTok doesn't know a lot about you. It knows what kind of videos you like, and then it'll show you more videos, so you'll spend more time on TikTok. And that takes money away from Facebook because you're not on Facebook if you're on TikTok. But just because they're taking money away from Facebook doesn't mean that TikTok is very profitable, because they can't sell their ads for a lot of money because they don't know anything about you. They just know that you like videos of people doing duets, or you like videos of girls in bikinis, but they don't know who you are, where you live, how much you make. And that's something that Facebook knows. And that's why the ads on Facebook sell for $3 when the ads on Google sell for 30 cents. And we don't know what the ads on TikTok sell for because it's not a company that's public, but it's definitely a lot less than Meta. So even if TikTok keeps growing, it's never be as profitable as Facebook because they don't know enough about you, so they can't sell the ads for very much. So if you had been looking at Meta and you think it always looks too expensive, now that everyone's panicking, it might be a time to think about it. Some other positions I have a ton of a company called St. Joe, and it's super cheap now. did a video about nothing. The price, I think, was as high as six. This company owns 100 acres in the Florida Panhandle beachfront property and 190,000 acres. Well, how much is that if you sort of visualize New York City? Uh, New York City is bigger than 190,000 acres if you include the water, but you don't live in the Hudson, you don't live in the East Bay, you don't live there. If you include only the land in New York City, I think New York City is like 290 square feet, sorry, square miles, and uh, this is a little bit less than all of Manhattan and Brooklyn and Queens and Staten Island. That's a lot of beachfront real estate. And for 15 years, the guy running it, Bruce Berkowitz, has been turning it around. And I think it's finally inflecting. So during the pandemic, all the people were moving from New York to places like Florida. And this company has definitely benefited from that. It was high as 60 something, and it's come down a lot in this latest market crash. And if I had money available, I might buy more, but I left my job January 1st, so I don't have a lot of cash to deploy, but I'm definitely not selling any shares of this. I think it's a great company. Another company which I own, which is not on a lot of people's radar, is called Fairfax Financial. And they're sort of like the Warren Buffett of and so the guy who runs this is Prem Watsa. He's also a billionaire. Fairfax is an insurance company, and he's sort of known as the Warren Buffett of Canada. And like Warren Buffett, he's a legendary investor. And this company, besides insurance, has other companies that they buy, just like Berkshire. And the main difference is this is like old school Warren Buffett, not like new school Warren Buffett, where he's willing to invest in things outside of the typical Ben Graham value investing. He still sticks to the old school and invests in things like junior miners and potash and things that would scare away most people, but that are part of the traditional value investing philosophy. Okay, got more questions here. Bought a small position in Foot Locker today. Hopefully, with the new CEO and these tariffs, they'll fully recover. I hope so too. I haven't looked at them. Illinois Toolworks is on my watch list. I haven't looked at that one in a while. That was one that I used to look at and always looked at. Always looked too expensive. ITW. Let's take a look. Compared to market, normally it's about a 15% PE average, and the companies like Google and Meta that are 20 or 30. But ITW, comparatively, 19 times earnings looks pretty good. And I haven't looked at this in years, but the name rung a bell. So yeah, not a lot of debt, and yeah, it's something to think about. So this wasn't one that I have on my watch list, but like MSCI, I bought this last year with like percent earnings, and it went up 30%. And I'm probably up, I don't know, 8% on this, but this is one for the long term. So people don't like to invest in individual stocks. Generally, they like index funds. And besides the S&P 500, one of the most common index is the MSCI Global Index, and this is the company that owns that. So as more and more people invest in index funds, you have to pay MSCI or S&P Global to use their index when you market your fund, because you're buying the stocks in their index. So as more and more people invest in index funds, companies like MSCI or S&P Global should do really well. So 38 times earnings sounds a little high, but it is a huge grower, and the CEO has bought millions back. I think like 7 or 8 million last time it dipped like this, and he's still buying. So I think it's a good company to own. S&P Global, I'm not going to look it up right now, but another one that always looks too expensive is FICO. So when you run your credit score, when you apply for a credit card or you buy a house, every time you do that, you have to pay FICO, and they give you a score. The banks love to pay it because there are competitors that run things close to that, and they call them FACO scores. But there's no real substitute for FICO in the terms of people's thinking. And if you worked at a bank or you worked at a credit card company and you use something FICO, and then you lost a lot of money, you might lose your job. So this is sort of the philosophy that IBM or Microsoft have, which is like you won't get fired for using this product, which is why everyone uses this product. Because there might be better things out there, but this is the low risk one that won't get you fired. And let's take a look here. Again, this always looks expensive, but it was as high as 2,400 this year. But with the lunacy and going on lately in the markets, yeah, might be interesting, right? So it got as high as 2,400, and that was right before the election in December, and now 1,800 at 86 times PE. See, this still looks crazy expensive, but if you look at it long term, it always seems to do all right. And I always regret not buying this, but if you look at the long term, like uh, for 5 years, you could have bought it at $400 5 years ago, and even after the decline, 1,800 now, you'd still be up 527%. So this is one of those ones where it always looks expensive. Only a lunatic would buy that, but it looks expensive. But as I said, 500% in 5 years. That's incredible. And so a lot of times, you would pay a high price like this, 86 times earnings, which will look cheap in the long term because there's so much growth baked into that. And speaking of that, I have a big position in a company called Coupang, and I did a video on that. And the only thing that now is going on with tariffs and if South Korea, and they're actually better than Amazon. I ordered stuff from now or 3 days from now. And with Coupang, if you order something by midnight, it will be on your door by 7 a.m. So they do Amazon better than Amazon. And part of that is because Korea is so concentrated. There are these giant mountains and people live in the valleys that live close together. So it's easier to develop a distribution network. But, they spent billions on their distribution network. And at this point, it's very tough for a new competitor to come in and take any share from them. So if you look at the PE ratio, 270, that looks outrageous. But this company just keeps growing and growing, and they have some advantages which aren't obvious from the price. One is the negative cost of capital. So if I wanted to expand my business, I would have to borrow money and expand it. But this company has a negative cost of capital. And how is that negative cost of capital? Because on average, when they pay a supplier, it's 90 days. So they buy something from a supplier, they have to pay them within 90 days, but they're so efficient and they're so good at selling that on average, they sell it within 30 days. So if you sell it in 30 days and you don't have to pay it back for 90 days, you've got like float in an insurance company, which is what Warren Buffett uses. And that number keeps going up because they've been growing like 30 or 40% a year. So that number, I think it's like 100 million now, just keeps getting bigger every quarter because, they sell things in 3 months. They sell things in 30 days, they pay it back in 90 days. And that's free money that they can use to buy more warehouses, buy more goods. And then that cycle just keeps getting bigger and bigger. And their advantage, their moat keeps getting bigger as long as that number keeps going up. So that's Coupang. Do you think Dow will cut its dividend? I don't know. It's not one I follow, but I don't know. That would be just a guess. A lot of companies are being very conservative and cutting their dividends. So DEA, which is Easterly Government Properties, I mentioned, cut their dividend in half, and other companies are cutting their dividend. And if you're just cutting it to be cautious, I think that's a bad idea. But if you have some plan for it, like you're buying back shares or anything like that, or you need it to expand or do other things with it, then sure. But just cutting it because everyone else is cutting it, I don't know. Did they say why they're going to cut the dividend? Let's see. What's another one? Google. So it seems like everybody knows about Google, but if you found with their AI stuff, it's fascinating. And I saw a tutorial recently on I forget what their AI is called, but because you have Google Gmail and you have Google Docs and everything on your computer, they're very good at utilizing their AI. And I saw a YouTube video where somebody opened up Google Sheets and then opened up the AI and asked the AI, how do I do this with Google Sheets? And it has an actual person, like you're looking at me, explaining to them how to do it as if it was a real person. And he said, you need to do X, Y, and Z. And then the person said, I don't know how to do that. And then the talking head, which looks like a real person, said like, okay, I'll walk you through it. Have you ever done functions? And he said, no. It's like, okay, well, with your mouse, right click this. So, I think for a lot of things, this is really going to take over because part of the reason that you get Gmail for free, if you ever read the terms and conditions, it says, we can look through your email and people won't read your email, but we can look through the text and target ads to you and do other things with the data. Well, what's one of the other things they can do with the data is use it to train their AI. And they actually have a feature now where instead of going to ChatGPT and say, write me a thank you email, and then it's like very stilted, and you're like, this doesn't sound like me, and then you have to send 10 minutes to rewrite it. Because it has all your emails and Google has the right to read your emails because you gave it to them for using Gmail. If somebody sends you a Gmail with this new Google AI, you can tell Gmail, write me a reply using my voice, and it will write it as if it was you. So just like ChatGPT can, write you an email, and you can say, write it in the style of Stephen King or write it in the style of George Patterson. There's so many Stephen King books that it can do it for you. But if you told ChatGPT, write me an email using my voice, it can't do it because it doesn't know who you are. But Google does because Google has all your Gmails. And so if you said, my mom wrote me this email, I don't want to write her back. Why don't you write back my mom, but use my own voice? And it will write it as if it was you writing to your mom because it has all the emails that you've written to your mom before. And that's very powerful. And I have a feeling that it's something that someone like ChatGPT or Claude or other AIs are going to have a problem coming up with. And Google is huge, but it has no debt. It's trading at 19 times earnings. And historically, the S&P 500, the average is 15 times earnings. So if you look at the average for the entire market, which includes things that are way overpriced, like Palantir and Tesla, is trading way above 15. But if you're paying 19 for Google, and the average is usually 15, and the S&P 500 includes companies that you probably don't like General Motors or General Electric, or Exxon, things that are not huge growers. And this is trading at 19, which is not that far above the historical average for the S&P 500. This seems like a good deal because not only do they have Google search and YouTube, and if you count YouTube as a search engine, then Google has the number one and number two search engines in the world. They have cloud, and their cloud is not growing as fast as Amazon Web Services, but their cloud is growing double digits per year. And if you could buy any tech company that is growing at 20%, 30% per year, you'd be happy to pay 19 times earning for it. You'd do cartwheels. And this is one of them that has a cloud division that's growing at double digits. And then if you talk about the big AI players, ChatGPT, Claude, things like that, Google's always in the conversation, and it's one of the top AI plays. And then they also have a bunch of moonshots that people don't think about. So like Waze or self-driving. And I know Elon Musk likes to brag about Tesla self-driving, but Tesla self-driving is shit. Google has really good self-driving with Waze. And sorry, I forget, is it Waze or what's their self-driving? And if you look at the two important metrics, which is how far you've driven, number of miles, and how many miles a human driver can go without having to touch the steering wheel, uh, Google is miles ahead of any other competitor. And by those two metrics, Tesla's like number 6 or 7. It's not even close. It's a joke. And Elon Musk is bragging that Tesla is going to start self-driving taxis next year, which he's been saying for the past 6 years. But even if it was true that he would start self-driving next year, Waze has been doing it, Google, for years, for like 5 or 6 years. They have fully autonomous taxis in Arizona. Now they've got them in California and several other cities, and it's going all across the country. So that's how far ahead of them. They've got like a 5 or 6 year head start where they've had fully self-driving cars for years, and Tesla is not even there yet. So I feel like that's something that's not priced into Google, and it's something that's going to benefit in the long term. So you've got the two best search engines, Google and YouTube. You've got cloud that's growing double digits per year. You've got one of the best AI plays in the world, and you've got a bunch of moonshots like self-driving cars, which could be worth hundreds of billions of dollars, and they are the top company in that. And they also have a negative cost of capital, so it costs them nothing to grow because they have no debt, they have a bunch of money, and the money comes in faster than they can spend it. So if they want to expand, it actually costs them less than nothing to expand. So that's my take on Google. And actually, even if you don't like individual stocks and you just want to invest in the index, you might be down a lot in the past week because of the tariff fears and things like that. One thing you could do, there's index funds that trade the S&P 500, like VOO, and then there's ones that trade a larger version of that called VTI. And they're very close because they have a lot of the same stocks. But with VOO, the S&P 500 is 500 stocks, and other ones have like 1,000 or 2,000, and they tend to run pretty close together. They might diverge for short periods of time, but what you can do to lock in your losses for tax purposes is sell one and then buy the other for 30 days, and then you can put it back. So you might say, well, I like the S&P 500. I don't want to own anything else, and that's VOO. But if you sell that and you buy VTI, which is the total stock market index, for 30 days and then move it back, it will probably be about the same price. But even if it isn't, if it moved like 0.5% or 0.75% more, you locked in your losses and you're able to deduct that on your taxes this year. So that's a huge benefit. Whereas now, if you're looking at the losses in the market in the past week and you're like, oh, I'm down a lot and I have nothing to show for it, if you move it from VOO to VTI for 30 days and then move it back, you'll be able to claim those losses and start over with a lower basis. And if you're the type of person who wants to hold things for years and years and never sell, this is an opportunity to sort of play that tax thing to your advantage. And then, yeah, so that's one thing you could do if you don't like individual stocks and you want to lock in that loss for tax purposes, but still own the same thing. You'd be buying something that's almost the same for 30 days and then moving it back because they don't allow the IRS to sell and buy the same thing. So you couldn't sell VOO and then buy Vanguard as the Vanguard 500, which is the same stocks, because it's a different company that has your account, but it's the same stocks. But you can sell one index and buy another index, even though they track pretty closely. What is your ambition for the channel? That's a good question. So when I was doing the stock picks for individual stocks, nobody watched it. I had like 100 viewers. And then somebody in the last video I posted was like, oh, if you lost 300,000 in 2 days, that must mean you have a lot of money. Lucky you, just like shaming me for it. But if you were one of those 100 people that had subscribed and had bought the stocks when I bought them and sold them when I bought them, you would have done really well. And I'm not patting myself on the back, but you can see on the video, like the update videos, when I said, okay, I sold this and I bought this and I sold this and I bought this. Some of them, like Scorpio Tankers, went up 100% in a year. What's some other ones? Taylor Devices went up 100% in a year. Kraken Robotics went up more than 100% in a year. And there's several that went up 50 or 60% in a year, like Smith & Wesson and Vitesse and stuff like that. If you had bought when I was buying and sold when I sold. But, nobody was watching the channel. And so when I did, just these life updates and about my retirement and stuff, it seems like more people are watching. And why am I going to do the individual stocks if no one wants to see that? I don't know. So I may just morph it into just a general personal finance or talking about, early retirement and stuff like that, because it doesn't seem like people want to see the stuff about individual stocks, especially because the individual stocks I was picking are not the popular stocks like Palantir or stuff like that. Like the stocks I was talking about, which did really well, like up 100% a year, are stuff that people never heard of, like Kraken Robotics or Taylor Devices or St. Joe. And even though I did a really thorough analysis, it would take a lot of prep work for that. And, if it takes a lot of time to do it and no one's watching it, then I don't know, why am I doing it? So, yeah, I don't know, maybe just a general personal finance and talking about earlier things like that. I don't know. I guess it would depend on what I feel like and what I want to see. But what kind of channel do you guys think it should be? I don't know. Uh, well, that's my thoughts for now. I think Berkshire is still a good one. It hasn't come down as much as the other ones, but Uncle Warren was selling off stock and building up his cash reserves, and that company tends to do really well in a downturn. So I think that one will do really well. Fairfax, which is the Canadian Warren Buffett, he does really well in a downturn as well and gets these screaming deals. And a lot of people don't know this, but in the book The Big Short, they talk about Michael Burry and a couple of other interesting characters. One of the people who had those swaps that did really well during the Big Short era was Prem Watsa of Fairfax Financial, and he's not talked about, in the same vein as Michael Burry and stuff like that. But he was definitely one of those people who saw it coming and made a lot of money off of it. And during a downturn, Berkshire is a great place to be, but so is Fairfax Financial. And he has another company. I have a big position in Fairfax, India, and that's sort of a related company where they own half of the Bangalore airport and some other things. And I think that's gotten beat up a little lately because of the tariffs. And, if tariffs hurt international trade, it's going to hurt international travel. And they own half of an airport. But if you look at Fairfax, India, I think just the value of the airport more than is enough to account for the stock price of the whole thing. And then you get everything else for free. And I should do a video on Fairfax India. Maybe if we keep this a stock video, I'll do that. But what's another one that I have? Scorpio Tankers. That's an interesting one. So Sting, and I did a video on Sting, and I think when I made the video, I bought it at 40 and I said it was a great deal. And then later I sold it at 80. And I still have some that I bought during the pandemic, which was like at 15. So I'm still up on it, but I don't know if I'd buy more or sell at this price because long term, I think it'll go well because the replacement fleet for new product tankers is not enough to replace the old ones that are being scrapped. But these things deliver gasoline and stuff like that. And if there's a economic downturn worldwide, there's less industrial production and there's less people shipping oil, there's less people shipping gas. So I think that's why this has gotten beat up. So it's being exposed to macro things, not because it's not a great company. Actually, if you were going to bet on a product tanker company, I think this is one of the best ones. I think if you want to bet on disruption, this is also an interesting one because when there's tariffs or trade wars or things like that, or terrorism, and you have to reroute ships, it's longer miles, and that benefits a company like this. With the current tariff situation, what might benefit is companies that do dry bulk. So if you look at the Baltic Dry Index and keep an eye on that, the last time Trump initiated a bunch of tariffs on China and they boycotted our soybeans, those dry bulk things did really well. And why is that? Because there's something that people in government will tell you doesn't exist, but absolutely exists. It's called transshipping. And what transshipping is when China was boycotting our soybeans, uh, dry bulk companies did really well because the price for dry bulk rate went up. And why is that? Because all these farmers that couldn't sell their soybeans to China, normally farmers in Nebraska and Texas and Iowa, they ship their grain to the California Port of Long Beach, gets on a boat, goes to China, and then we give it to the Chinese. The Chinese said they don't want our soybeans. So what happened? Instead of shipping it to California to the Port of Long Beach, they shipped it down to Texas to the Port of Houston. And then from Texas, they shipped them down to Brazil. They take it off the boat in Brazil, put it on a different boat, and now they say they're Brazilian soybeans. And then they send those Brazilian soybeans to the Chinese, and the Chinese buy them, and that's how they get those soybeans. And if you think about that, it's like, well, they're not really Brazilian soybeans, right? And it's like, of course they're not Brazilian soybeans, but the paperwork says they are, so it's fine. But What changed? Instead of sending it from here in Nebraska to California to China, you sent it to Texas, down to Brazil, around South America, all the way to China. And that's a lot more miles. And so companies that do dry bulk benefit from stuff like that when you have these trade wars. And I haven't bought any specific dry bulk companies just because I don't know how long this trade war thing is going to go on. It's very erratic. But if you think this trade war thing will go on longer, I mean, that's one of the things you can look at is companies that do dry bulk. And I don't know. That's just my thought. But yeah, it is a waste of fuel, obviously. But people respond to incentives. And if you do something at the government level that's going to keep people from making money, they're not just going to go, oh, darn, I guess my kids aren't going to go to college and I'll lose the roof over my head. They like making money, they like being rich, and they'll find a way. And if you remember during the war in Yugoslavia, when the U.S. was bombing there were actually parts of Yugoslavia, and they're separate countries now, that were fighting with other parts and murdering each other and shelling, but they were still producing cars. They were making Yugos. And why is that? It's because there's money involved. And if there's money involved, even if people are killing each other all around you, people are going to find a way to make money. And, I think transshipping and, avoiding tariffs is silly, but, people want to make money and that's the way to do it. And if they can do it in a way that they don't get caught by, shipping the soybeans to Brazil and putting them on a different ship and just giving them different paperwork, that's what they'll do. And in fact, this happens all the time. China used to import a lot of bogus honey to the US. So honey comes from bees, but the Chinese would make it in a laboratory and ship it here. And when people tested it, they saw that the honey was fake. And so what did we do? We banned the import of honey from China. And then all of a sudden, a bunch of honey started coming in from Malaysia. And if you sat down with a pen and paper, you would see that it's more honey than it would be possible to produce in all of Malaysia, but it was coming in from Malaysia. But it wasn't coming in from Malaysia. The Chinese were now shipping their bogus honey to Malaysia and then putting it on a ship and sending it here. And now it's Malaysian honey. So it happens all the time. Let's see. Do you think the decarbonization ambitions maritime might lead to more ship orders, lots of orders? Yes, but there was something called IMO 2020, which helped a company like Sting because IMO 2020 said that you had to use scrubbers on your ships to clean the stuff coming out of there or buy low sulfur fuel. So the stuff that the ships burn is the shittiest thing you could ever imagine. So when you put petroleum in a cracker, which is what it's called in a refinery, it breaks it up into different things. And up at the top is stuff like butane that would be in a lighter. And then you got gasoline, you got heating oil and stuff like that. And at the very bottom, the crud that you scrape off the bottom is asphalt. And right above that is the stuff that the ships burn. They call it bunker fuel. And it is so crappy and thick that it's literally solid at room temperature and you can walk on it. It's sort of like the texture of peanut butter. I've held it. It's disgusting. But at room temperature, it's solid. You can walk on it. It's like the texture of peanut butter. And that's what ships burn. And they pollute a lot. And so in 2020, they came out with this requirement that you had to either put scrubbers, which are millions of dollars, on the ship, or you couldn't burn this crap. You had to burn low sulfur fuel. And low sulfur fuel costs more money. And so if you had a new fleet like Scorpio tankers, you would put the scrubbers on, and then you can burn the cheaper fuel, and it gives you a cost advantage. And then the people with the older ships, they were burning the more expensive fuel, and there was this cost disadvantage. And they would not put the scrubbers on their ship because the ships are so old, it's not worth it. And a lot of those ships end up being scrapped, and a company like Scorpio makes money. So what does that have to do with LNG and methanol and stuff like that? There's something coming out called IMO 2030. And that one, they're going to decide on whatever the new fuel is. But they haven't decided if it should be LNG, methanol. What's that thing that they make before they make fertilizer? Ammonia. It might be ammonia, but when IMO 2030 comes out, they'll decide what the new standard is. Yeah, ammonia, and the new ships will have that. And that's sort of like why a lot of new ships aren't being ordered, because they don't want to waste money ordering this ship if they know in 2030 they're going to have to change it, because it's going to be a lot of money. But whatever the new standard is, that will definitely lead to more ships being scrapped, and that's why companies with newer fleets like Scorpio, should benefit because, uh, yeah, and whoever buys new ships, obviously, um, it's going to benefit if you have a newer fleet and if you have good financing, because there was something called the Basel Accords, where banks come up with different standards, and I can't remember if it was Basel 3 or Basel 4, but after the great financial crisis, they made it harder for banks to lend money on things like ships. And so they would have to have more net capital if you lend on things like ships. So all of a sudden, banks didn't want to lend to ships. And governments like Korea and China, which build ships, they subsidize ships. And so now, if you want to build more ships, it's harder to do with bank financing. So it's kind of going to be a shift to not only what type of fuel you use, but who has better financing. And that might mean exposure to sovereign wealth, like in China, or it could be exposure to private equity, or the people in the Middle East that have a lot of money. I don't know, but it's going to change the landscape, definitely. Many ships are ordered for methanol, but those are dual fuel ships. Yeah, that's something they're experimenting with. Also, is the dual fuel ships, because you still have contracts with your customers and you want to keep things moving, but if you sort of don't know which way IMO 2030 is going to come, you can do this dual fuel thing, and you're sort of hedging your bets, so you can still make money in the meantime. But anyway, I have to go, but maybe we'll do another live chat next week. So good luck, everyone. Stay out there.